Okay, hello everyone. The time is now 2 minutes past the hour, so we're going to get things started. Just as people trickle through, maybe following lunch or with their lunch, we'll start with just some general introductions and some context setting, such that any latecomers won't miss too much. Firstly, to say is thank you all very much for joining. We know that in this day and age, webinar invitations are numerous, and so we appreciate you spending the next hour or slightly less with us today. Our subject's an interesting one, the lender path to net zero. Our point of view at Kamma is that data should illuminate that path, giving us clarity over our next steps and lighting it all the way towards 2050 and beyond. But too often, weaker data prevents us getting there, often leading that pathway, in this overused metaphor that I've started on, to be too dim, or perhaps even lighting the path towards the wrong direction. So today we're delighted to be joined by a range of experts, and we're going to be talking to you around how better data can lead to better decisions and ultimately faster progress towards net zero. So who are those illustrious speakers? For many of you who've met me before, hello, welcome back. I appreciate your time today. For those who haven't met me or heard of Kamma, Kamma is a geospatial technology company. We use high-end mapping tech to build very advanced data sets around UK property. We typically tend to acquire more data than anybody else. We've got exceptionally rich profiles around the energy and environmental impact of UK property. And then we build analytical techniques and solutions on top of that to support a range of different mortgage lenders, from Atom Bank and Just all the way through to NatWest and Paragon and numerous others as well. I'm Joe Webb, the Chief Growth Officer, and it's my job to narrate us through the agenda today. We'll be delighted to be joined by some exceptional experts from around the industry. And so that I don't stuff this up, I'm going to ask them to introduce themselves and their organizations. So Heather, over to you.
What do you think? I'm just double checking in the chat if everybody can hear, because there are a couple of people, I think, Joe, that looked like they were having difficulty getting on, but I will crack on. So thank you very much, everyone. Heather Buchanan. I'm co-founder and chief executive of Bankers for Net Zero. We are a not-for-profit member body, and we are not just banks, as it turns out. So we're delighted to be here joining Kamma for this. We convene the UK country chapter of the Net Zero Banking Alliance, and we look through the lens of the commitments that financial institutions have made to decarbonizing their financed emissions. And there's a great deal of work going on internationally in terms of standards and all the rest of it, but that little line, which sounds quite simple, means, of course, that lenders are now on the hook for every single mortgage that they write, every single mortgage that they hold, every business loan, every corporate loan, the corporate's entire supply chain. And so they're needing to get data in a way that they've never actually needed to get before. So this is a really interesting topic for us, because it is probably one of the biggest battles in terms of data technology that lenders are looking at now. And if we're really going to get finance flowing into the real economy for decarbonization, we need to crack the data challenge. So I'm very excited to talk about that today.
Thank you, Heather. And Tom?
Yeah, thanks, Joe. So yes, I'm Tom Kenny. I'm the Group Property and Credit Risk Director at Just. We're a UK-based life insurer, FTSE 250. We have a few business lines, one of which is our lending business. We're a later life lending business, a key member of the Actual Release Council. And that's kind of why I'm here to talk about what we've been doing in our lending business to address our sustainability strategic aims. We've been working very closely with Kamma. I'm very passionate about this subject, and hopefully I can share some of the insights that I've learned along the journey that we've been going through with Kamma.
Thank you very much, Tom. Just to go back to that, we do seem to have about 10% of participants struggling with Wi-Fi issues. Given it's 10%, it's likely local, and there's not a huge amount we can do centrally to improve that. But we will be sharing a recording from this webinar. So unfortunately, if there are issues, please bear with us and see if they can be resolved locally. But if not, we'll make sure you have all the materials after the session itself. So what are we here to talk about? One of the benefits of having a range of speakers with different levels of expertise is that we can offer you different perspectives on the key issues today. So first of all, we'll start with a panel discussion. We're going to go through some of the key challenges, and we'll invite Heather and Tom to offer their opinions. We will then, as Kamma, talk you through some of the key challenges, specifically around the data issues and what can be done to resolve those. The benefit of having Tom here is he can then talk to you specifically around practical applications, taking us from theory into what's really working, what better decisions you can make, and what better strategies you can pull together when you have better data in today's world. And then lastly, we'll have Heather talking about industry best practices and policy expectations for tomorrow. So Kamma around theory, just around practice, Heather around what is coming next with a unique perspective given how she bridges Parliament with the wider industry. So where are we today? The first point is probably one that's not completely unexpected. We're not moving as quickly as we need to. It can be complex because you do hear a couple of political voices making rightly pointing to strong progress for the UK, the first major economy to decarbonize by 50% versus a 1990 base level. But unfortunately for property, most of that progress comes in the area of decarbonizing our energy supply. We've pretty much phased out coal. There's one last coal power station in the UK which is closing this year. We've invested dramatically in offshore wind, and that means we have one of the cleanest national grids in the world. What we haven't cleaned up to a large extent is the properties that we live in. And so when you look at the UK's NDCs, whether it's a target of decarbonising by 68% by 2030 or 78% by 2035, what becomes apparent is that property itself is a long way behind that. In fact, compared to a 1990 target year, we've only decarbonised by 14% since that point. So whoever comes in during the next election, whoever ends up leading this country through the next phase of net zero strategies, they will have to face this reality that we're not moving fast enough. And as Chris Stark, who was recently the CEO of the Climate Change Committee, states here, we haven't got the policy package to close all those targets just yet. So we're going to have to see some attempts to catch up both at national and, I expect, sector regulatory level as well. What is the challenge here? What's holding us back? If you've worked with Kamma before, you would have seen a slide like this. It's one of our favorites. Essentially, we've all heard this key point around how one of the biggest challenges facing the UK is that we have the oldest housing stock in Western Europe. And this shows you that in diagrammatical form. So from left to right, you can see the last 100 years, and the squiggly line along the top shows you the number of properties built per year during that time frame. What we've been able to color in using our own data set is the number of properties which are efficient. So that's an EPC grade C by today's standard. So you can see for a large part of the last century, building homes to an efficient standard was nowhere near a priority. In fact, it was only when we got to the 70s, and this will sound familiar, there's an energy crisis, that people started to think more fully around their energy usage and how we could build homes to a higher standard. Obviously, we also switched to central heating around the same time frame. We got double glazing in the 80s. We started to build homes to higher regulations and with better materials to get to the position where we are today. But we're still not building homes to a net zero standard, and we won't in large numbers until the future home standard comes into effect next year. So at this stage, Heather, it'd be good to get your perspective on how Bankers for Net Zero is thinking about the challenge around retrofitting.
No, certainly. So this first and foremost, probably the biggest challenge that our members are facing and that banks and lenders are facing, because ultimately it's not about just putting some more green mortgages into the mix and everything's okay. The cost of retrofit is so high, and the payback period can be quite long. So this is an area where we certainly see the need for quite a bit of extensive government intervention. And it's a tough one because it also, obviously, you're intervening in people's lives and in their homes and probably the most personal asset that they have. So I cannot tell you the number of politicians and ministers that have come to me and said, oh, can you just tell the banks, please, to start writing more green mortgages? And, that's not the issue right now. The issue is the demand side. And so the key element here is that we're going to need to stimulate demand, and there's absolutely no silver bullet for it. It's going to require multiple interventions in multiple different ways across multiple different markets, depending on whether it's owner-occupier, mortgaged, unmortgaged, social housing, rented accommodation, the lot. So we definitely see this as something that requires some quite big thinking and some quite extreme collaboration to make it work at the scale that it really needs to.
Absolutely. I think the key point of no silver bullets is one we definitely agree with, Kamma. We do, as well as see this challenge around retrofitting for all properties. Obviously, how you retrofit a home depends a lot on the type of property you're looking at, and also, of course, when that home was built. A lot of the major parts of the country were built during the latest parts of the Industrial Revolution up towards 1900 and slightly long. They're all built with one layer of brick. Rather than two with the cavity, which you saw growing in popularity throughout the 50s. So a heterogeneous approach is definitely needed. If we look at our next slide here, the question really is, what does it mean for lenders? Why should we as an industry care so much about whether or not homeowners or landlords want to retrofit their homes? When we think about the climate challenge for lenders, we think about three categories here. So the one we're probably most familiar with is new risks. So there is this challenge around physical risk and increase in flooding, which could impact both the value of a home and an asset, but also the ability of a homeowner to pay. Transition risk, obviously, it's governments legislating, trying to reduce the impact of climate change. They're trying to reduce physical risk. They'll bring in new regulations which may impact industry, change how companies are valued, for example, or change the asset value of a property such in a way that lenders have to reprice or consider new LTVs. New reporting, again, so under TCFD regulation, which came in 2022 for large listed companies, companies now have to report on their financial emissions, just as the way you might have to report on your financial health. You have to report on what could be termed the environmental health of your company. What's the profile? How are you supporting or contributing towards climate change? That is being strengthened, so it's now been taken over by ISSB under IFRS S1 and S2. S1's kind of in line with what we've seen before, but S2 is interesting because it talks about having to disclose how you are measuring, managing, and mitigating climate risk. And of course, there's no rule book to always been written here, so you might have a good sense of how you stress test physical risk, but not on the transition side. And then lastly, this just challenge around new roles. So Heather hinted at this as well. So lenders being asked to write more green mortgages. Is it really that simple? Lenders for a long time have been very simple organizations. They take money from a range of stakeholders who, as a service, provide interest and a safe way of storing those funds. And then they lend them out to others in such a way that they can become profitable as organizations, but they're serving different needs of the wider economy and the community. That's a long way away from where we are today, where lenders are being told, how can you support your customers towards net zero? What can you do as a stakeholder in that process? It's a new role for them, which is particularly challenging when you consider that many lenders don't really have much in it by the way of customer conversations, when 80 to 90% of the market is still intermediated. So new risks, new reporting, and new roles. Tom, how does this slide resonate with you? How have you found these three challenges at Just?
So I would say understanding the risks is a key challenge. So we've spent a lot of time getting our heads around what physical risks do we think we're exposed to based on a range of climate scenarios over different time horizons. And then we've obviously looked at transition risk, and what kind of surprised us, but when you take a step back, it kind of makes sense, is that transition risk is by far the bigger risk right now, and the one that's more likely to hit lenders sooner. And so getting to grips with what transition risk looks like, what could drive transition risk is really important. And that's largely driven by policymakers. What regulations will they implement around minimum energy efficiency standards? When will they do it? What exemptions will they have? That sort of clarity that you need to fully understand the risk is something that's missing at the moment. Hasn't been helped by the sort of pause in policy making. So I think that's really critical for lenders to truly understand their risks. But as a starting point, you can just simply look at what's your data telling you. What is the distribution by energy efficiency, and sort of play out different scenarios. So let's say government implements a minimum standard of C or average of C, or so you can start to understand what that would mean for you as a lender. And I think that's a helpful exercise, because then you can sort of engage with policymakers to make it clear to them what it could mean for your organisation. But more importantly, you can start to understand what risks you're exposed to. Reporting is really important, obviously, and having good data, accurate data to feed into that reporting is incredibly important, so that people that read your reports can rely on it. And then I think the retrofit piece, being a later life lender, it's a bit different to mainstream lending, but retrofit is quite a different customer journey to what normal lending entails. So thinking about how the customer journey needs to change, who the different stakeholders that need to be involved is really important. And that's something that I've been trying to develop through the Ex-Release Council, through agreeing a set of principles and guidance, so that we're all trying to work from the same sort of customer journey.
Absolutely. And again, I think the point around clarity is one which resonates not just with this industry, but with many others. I'm thinking about the change in target date for the ending of the sale of new petrol engine cars, for example, pushed back from 2030 to 2035. And some of the major auto manufacturers, as much as the government thought to be welcome news, were complaining that the investments they'd made were geared towards a target date of 2030. And inconsistency in policy making, changes in policy making are obviously very expensive at the industry level. Heather, any thoughts from you here, or should we crack on?
We'll crack on, then we'll go from there.
Fair enough. We've got plenty of time later on.
Mm-hmm.
Okay, so this is one which I'd definitely love to get your sense of, Heather. So how might this change? Obviously, we've got an election coming up on the 4th of July. I actually used to work for a research firm that did a lot of kind of polling around who would win the next election. And partly as a result of that experience, I prefer to use bookmakers now as a key source of data on what might happen next. At the moment, we've got the Conservative victory priced at 10-1 and the Labour victory priced at 1-20. So translated into probabilities, that's pretty much a 9% likelihood of winning for Rishi Sunak and 91% chance for Keir Starmer here. Now, we're starting to see manifestos emerge. The Conservatives launched theirs today, Lib Dems yesterday. We've already got a fairly decent sense of how this might impact the climate agenda. Heather, what are your thoughts?
Well, absolutely. I've been moderately delighted to now that, to a certain extent, the environmental agenda hasn't become the political football that it could have. Having said that, it hasn't escaped unscathed, certainly. I think we only looking to the first debate that we had with kind of the talk about people being forced to retrofit and being forced to invest, and the extra cost, the extra burden. And I think there's the real opportunity here that we need to kind of talk about is how do we kind of reset this narrative around what's the opportunity for having warmer homes, what's the opportunity for having a kind of better living environment. But a lot of that is going to come down to policy and different kind of policy levers that I can speak to a bit later, that will enable finance to flow without too much of a capital burden, particularly on those that can't afford it. I think the point here is it is possible, and I think this whole agenda, it's been, as let's face it, with so many things in politics, it's been kind of oversimplified. And there's this is where we really need to lean in, and where industry needs to lean in, and others, and say, no, there are ways to work through this, and really start looking at the cost of not doing something rather than the cost of doing something. Because right now it's, but we're in that lovely time, and as my famous last words, we've still got a few weeks for this to turn into a nice big political football, if it needs to. But fingers crossed, it won't do much.
Yeah, we definitely echo that. I think some of the challenges are that, much like with property data, political data isn't always perfect. And so a lot of the time you'll see policymakers or strategists respond to, small signals in the data. So I think the ULEZ by-election was one of the few that Rishi Sunak wasn't soundly defeated, or his candidate wasn't soundly defeated by the opposition. And that's then seemed to echo it towards larger and larger policy changes with regards to things like, pushing back the deadline for the end of the sale of petrol cars, but also, of course, what's crucial to this industry, the will they, won't they approach to minimum energy efficiency standards. So the simple data is that at the moment, the minimum level of standard for a private sector property, it can be let out as long as it's higher than a grade E property, which basically means that the least efficient 3% of homes in the country cannot be let out. When that changes to C, we're in effect saying the least efficient 60% of properties in this home can't be let out. So it is a fairly large deal, and it's something which sits in the Lib Dem manifesto. Labour have recommitted to it, as the Conservatives haven't, and that could be something that's worth considering as we get closer to July the 4th. Okay, so if we wrap up our debate at this point, then one phrase that we use within Kamma to try and explain the crux of the problem of where we are today is that we have all these new challenges. We've talked about new risks, we've talked about new regulations, we've talked about the new roles that mortgage lenders expect to play. That all leads to more demand for property data and demand for better quality property data. But the issue is we haven't taken the time or the investment over the years before that demand existed. We haven't had the money to invest in improving it. So very typically, we find that property data is hard to acquire. It can be hard to get access to the files you need, the data you need. Even if you just want to buy a single home, for example, think about the weeks and months you spend waiting for surveys and data to come back to you. That's one example of how hard it can be to acquire property data. Typically, it's hard to integrate as well. I've been working in customer and consumer data for most of my career, and when I got to property data, I was quite surprised that a simple problem like having a flat called flat A in one data set or flat one in another was enough to confuse some of the biggest companies in the market today when it comes to trying to integrate, say, one property data set with their own back book. And then lastly, it's hard to use. So we don't always see the same level of analytical expertise applied to property data that we see on the customer side. What we'd like to do for the next couple of sections is, first of all, talk you through some of these challenges and give you some practical tips on how to surmount them before asking Tom to weigh in on his personal experiences and the experience of Just as something of a case study, if you like, for what better data looks like. And then lastly, that provides the foundation in terms of what happens if you solve today's challenges to lead on to Heather's section around the problems of tomorrow. So these are the steps in the process we'll talk you through. I'm going to start with the first 4, and Tom will pick up with steps 5 to 8. Putting it simply, referring back to those challenges of acquisition, integration, and usage, we're going to talk around what better data can be acquired. We're going to talk about approaches to closing those blind spots and what that can mean for you as a lender, before looking at some approaches that can help you to assess your back book and the risks involved there, and also then assessing customer needs, which is crucial when it comes to supporting them to make different decisions around things like retrofitting and their environmental impact. So first of all, let's consider the challenges around data acquisition, and specifically the challenges with EPC data on this slide. So first of all, probably the problem we all know about is that EPC data is incomplete. So it only covers about 51% of properties in this country. And of those that are covered by an EPC certificate, the certificate itself is typically quite old. So an EPC can be active for 10 years before it's marked as expired. What we find is if you add in those properties which have no EPC, which is older than 5 years, with those that have no EPC altogether, the end stat is something like 76%. So 76% of homes lack an EPC certificate that's less than 5 years old, or lack effective data, which is less than 5 years old. There are some more challenges there as well. So there's challenges with how you access that. If you use the government's open data file, which they do give you quite freely, it's one of the few sources which is easy to acquire, but there are countless problems with it. Essentially, there's no normalization when they produce that file. One of the biggest problems within that is that, and all those improvement points they put in there, whether it's capital installation or solar PV or just changing some light bulbs, they'll use cost data from 2012. So frequently the costs are out of date, costs may be too low because of inflation. Typically they're higher because the tech itself has improved and become cheaper. You could also typically look at fuel savings in 2012. So the only silver lining to a crisis as big as the energy crisis is that it's changed the game for the return on investment of certain retrofit improvements. Again, the EPC doesn't reflect that because it's telling you the fuel savings you'd achieve over 10 years ago. And then lastly, when it comes to looking at your financed emissions, we've got some more data around this later. But essentially, you're using data from 2012 before we saw the decarbonization of the national grid, which ultimately means a lot of lenders still reporting on inflated metrics. There's also no validation with that file, so Kamma's exhaustively gone through and corrected. But we see things like lack of complementarity between different data metrics, and lack of data, so no certificate references, all certificates not having UPRNs. It's not always updated to be as accurate as you need it to be. And also, we ran emoji bakes, so they take the data in one format through the assessor's iPad or tablet device. That then goes into a portal, which is used, you can use to search any certificate. When they produce an open data file, they'll convert it by clicking a button without actually checking the quality of that data whatsoever. And so frequently values are lost in that process. So lots of issues with the data to begin with. What might a better source look like? This is just one example of the many different data points that we've found, which can give you a better read on where you are as a business. So we talked a little bit about those emissions data and how that can be inflated, impacting regulatory disclosures. One interesting fact here is that, again, because the EPC is stuck in 2012, it assumes the national grid is quite filthy, and that for every kilowatt hour produced by the national grid or used in the home, it generates 519 grams of CO2. That's the carbon intensity factor, which is used to then work out the emissions of a property, which then feeds into your disclosures as a lender. We have a real-time data for feed from National Grid, and what we found on a 12-month rolling average, we actually produce only 173 grams of CO2 per kilowatt hour. So it's pretty much a third of what the EPC register thinks it is. And this is just one problem amongst many. Updating the data in this way allows you to do a number of different things, but more important than anything else is probably set an accurate baseline. We'll get more information from that on Tom shortly. Closing blind spots. So this chart in my head was a super clear depiction of how challenging it can be when you don't know which property is which on your back book. Now it looks like lots of different properties of different colors. It's a bit of a rainbow. So allow me to talk you through it. Essentially, we know that flood risk is growing. The Environment Agency finds like 1 in 6 properties, or almost 70%, are at heightened risk of flooding thanks to climate change. And typically, we've got anecdotally some data from our clients that previous suppliers struggle to match more than about 4 out of 5 properties. So they leave a data gap of 1 in 5 or 20%. What we're showing you here is that it's the cost of that gap. And our central thesis is that as those risks, those climate risks increase, the cost of not knowing about, say, a fifth of your portfolio leads to increased costs. So what we're seeing in an infographic here, green is properties with no flood risk, yellow where there's a known flood risk, you've spotted it through perhaps some flood mapping work. But the remaining 20%, there's no data on that. So within that final group, we expect 20% to have unknown data, and 70% of 20%, in other words, 3%, has risk which hasn't been spotted. The challenge with this is multiple. So first of all, obviously, you may be mispricing the mortgage. You may have overestimated the value of the property. The occupant themselves, the homeowner, may struggle to pay a mortgage if they're flooded. And also, let's consider for a moment the role of flood re here. So flood re is the government's reinsurance scheme, and they will insure properties which the private industry doesn't want to up until 2039. And I think the reason for that deadline, is the assumption that by that point, flood defences can be built, which is working good enough idea, if you like, if it wasn't for the fact that most flood risk or some flood risk is unknown. So if 3 out of 100 properties have flood risk and you don't know, you don't spot it and it's there, who's therefore going to go and tell the homeowner or the landlord who's spotting these risks and helping us to manage them? If the data's lacking, then the answer is nobody. If you then extrapolate this to national level, you see deeper challenges. So 3% of loans have hidden flood risk. That basically means 18 billion at an industry level of mortgages have heightened arrears risk, and that's threatening the valuation of 353 billion in property assets. So it can be a challenge, this data blind spot. Lastly, we're flipping back to EPC from flood here, but again, because half the country doesn't have one, there's some real challenges in predicting the EPC of the remaining part of the portfolio. We've seen some fairly interesting approaches to this, or questionable, I should say. So one data set we looked at, the previous supplier had used a postcode average, which is interesting because obviously you can get some averages which are very close to the top and bottom, and some which are the same number can average with extraordinary ranges. So it's a bit of a challenge to do that, especially across a large portfolio. The approach we found to be of most use is multimodal. And the reason that's better is because it allows you to fit the right method to the property rather than using one method for the entire back book. So we start with a geospatial analysis of shared buildings. We find that flats are the easiest to predict, and that's the best route for those properties. Not every home is a flat, so then we deploy some AI-based machine learning. And lastly, where we aren't happy with the accuracy levels of that particular approach, we can then switch back to geospatial, look at a neighborhood analysis, match on some other key variables, and in doing so, predict EPCs to a higher level of accuracy. So multiple approaches delivering more success here. And then lastly, thinking about these emissions then, we talked about updating the carbon intensity factors to give ourselves a more accurate view. If you do have a more accurate baseline, you can then predict that or extrapolate into the future with more accuracy and more certainty. Now, let's be fair, when we are looking at the future, we're also using a crystal ball. We're making a variety of assumptions which may or may not happen. But by painting different scenarios, we can give decision makers a clear view on what might happen and support target setting. At the moment, it's still an early stage. We're seeing divergent responses in the market, but typically lenders might say, we're going to set a really aggressive climate target. They'll come up with some big number. We're going to decarbonize by 60% by 2030. They haven't necessarily had done the homework to assess what does that look like? What other factors need to be involved? What's determining the impact of say, macro factors like the national grid or the rate of house building or the residual impact of housing stock improvements anyway? Other lenders may be more cognizant of these things, and it leads them to err on the side of caution. They're not confident in these policy commitments, and therefore they set much smaller targets or refuse to set a target because they don't want to be on the hook for something which they can't control. The benefit of this approach is multiple, therefore. So first of all, you can paint different scenarios. You can get a clearer read on what might happen next. You can therefore set more robust targets. But secondly, and perhaps equally as importantly, you can also be very clear what the dependencies in that plan are. Heather mentioned at the start of this call, ministers are saying to her, can mortgage lenders just write more checks? Can you write more loans, more green mortgages? And it really is not that simple. The benefit of planning in this way is it clearly articulates to government what their role in this process is. So if a lender is to achieve a certain energy efficiency target, if a lender is to decarbonize by a certain point along that road to net zero, this allows them to be clear that not every single thing that needs to happen sits within their control. So whether it's better support for national grid, whether it's an increase in home building and a proper future home standard which guarantees heat pumps and solar as part of the original build plan, whether it's an increase in the improvements of UK housing stock, this approach allows you to basically push those targets back up towards government and say, we'll do our bit as long as you do yours. And then lastly, as well as looking at different ways in which you can set targets and model out the future to get that, we also talked about how better data can support you to better assess risk in your back book. I want to return to one of Tom's comments here when he talked around clarity around risks. There's something we refer to internally as the transition risk paradox. And the paradox is that compared to flood risk, where we've got a clear view of how to stress test thanks to CBES and NGFS scenarios that lead up to 2050, we don't have clear instruction of how to stress test a transition risk. In fact, we don't always know what that transition risk would look like. Regardless of government policy, we know that the Climate Change Committee have been clear that 89% of UK homes need to be A to C by 2035. And so we can use C as a minimum standard to model against that. By upgrading, updating the cost data we have access to, we can pull together a much more accurate view on how much it will cost each property in the UK to get to that C level. And in doing so, that then gives us a clear data point which can fit into two questions which amount to some standard stress testing. So question one, can the cost be absorbed into the current loan? So if you add that cost to C to the outstanding balance, does it fit within the original agreed LTV ratio? And if so, then arguably you can lend on the same terms and that property itself is not high risk because it's affordable for that property to get towards C. Similarly, could you offset the cost of C against the value of the asset? We get asked by lenders to assess whether the cost of C is more or less than 5% of the value of the asset. And again, if it's less, you can argue it's lower risk because it is affordable to get there. So two questions to ask, can the cost be absorbed into the loan and how affordable is the cost of retrofit versus the value of the asset to allow you to stress test, to fill in this kind of gray area of how to stress test transition risk. Again, possible with more and better data. And this last day I want to talk around outside of the lender's day-to-day is how do you better support customers? Now, there is an awful lot to say about the retrofit challenge, the barriers, the opportunities, what's working and what isn't. One thing that we would say to try and cut that story short is that we don't think that any lender out there has done a perfect job of saying to their customers, these are all the benefits and aligning them with their own interests, their own needs, their own objectives. One example of that is when lenders typically put retrofit packages in front of their customers using a variety of different industry tools out there. They're often backed by the wrong kind of data, or they ask too many questions, or they come back with a max retrofit package, which we know doesn't work for most homeowners. The research we've done under the GHFA highlights that some people are willing to spend lots of money, but not everyone is. And therefore, it's vital to take a whole of market approach and get some different solutions for different budgets and different homeowners. So the shaded blue area tells you, the question here was, what's the most you're willing to spend on retrofit? And the shaded blue area shows the proportion that are willing to spend at each different price point. So most were willing to spend, I think, up to £1,000. Then the drop-off became quite steep after that point. The points in the coloured boxes here tell you that if the cost is about £15,000, that's going to work for about 10% of people. If it's £10,000, that will still only work for about 30%. And again, most max retrofit packages are priced between £10,000 and £15,000. So you're losing between 70 and 90% of your audience at that point. You can optimize, bring costs down, show them cheaper options or a range of options. They can come to you. You could come to, say, a budget which is £2,500, and that could work for 75% of the homeowners that we spoke to. So when we think about retrofit, think about needs, think about budgets, and think about a whole of market approach to better target those individuals and drive more activity. Okay, so that's me on the theory side. We thought rather than me just popping on about methodology, it'd be great to get Tom here to talk around how they've applied that in reality. So over to you, Tom.
Thanks, Joe. So I'll move on to the next bit. Oh, there we go. Right. So I'm going to talk to you about these other 4 elements around financed emissions, how you set targets, how you understand the transition risk, and then how you can support customers. So this slide gives a useful kind of summary of some mainstream lenders compared to Just. Key things to call out: financed emissions. How do you actually calculate financed emissions for a mortgage book? Well, yeah, I think the industry standard is to look at the energy efficiency ratings of the properties, where they exist and where they're up to date, and then fill in the gaps with modelling. And Joe has talked about that a little bit. Clearly, the accuracy around that can vary significantly, and there are big gaps in data. So you really have to spend quite a lot of time cleaning the data, getting comfortable with it, so that the emissions that you're calculating are credible. So that's a lesson that we sort of learned over the last year or so. But then there are different sources of data that you can use, right? You can lift the information directly from the public database, and that'll give you one view of your emissions. But if you want your current view, the most up-to-date, the most accurate view, then it's better to use more up-to-date emission factors, which is what Joe was touching on before. And that's why we decided to work with Kamma to get a more up-to-date view of where we thought the emissions were. You might think, well, doesn't that cause complications around where your baseline is? So that's one of the things that we had to look at last year, and effectively we re-baselined just to make sure that we weren't taking credit for a change of calculation without actually reflecting that in our baseline, and that's something that we'll look to address this year. So effectively, financed emissions, like I said, it's based off the energy efficiency ratings and kind of the LTV that you're actually the lending that you've made against those properties. Just Group disclose an economic efficient emissions intensity factor, and you can see that it's roughly in the same ballpark as NatWest, and you wouldn't expect it to be significantly different, to be honest, because no one's really changed their lending significantly enough to change the shape of their portfolio. But perhaps that might change over time. And the PCAF score, as I was talking about, data accuracy is really important. So we found getting a PCAF score helpful to just give us a sense of, well, how well are we doing about the way we're pulling our data together and the modelling that we're doing. Really, when it comes to emissions, I mean, what's to say? Why are we doing it? Part of it is disclosing where we are, but more importantly, as a company, Just Group have targets, right? So we've got a 50% reduction by 2030 and net zero by 2050. A key part of understanding and helping to develop our transition plan was, well, we know where we are today. Where do we expect to get to? If and this is not what we're planning to do, but if we were to do nothing, how far along that journey would we get with policymakers implementing the policies that they say they're going to implement? So decarbonising the electricity grid, government incentives to help people modernise their homes. What sort of impacts would those have on your mortgage book, and in our case, our mortgage book? So that's what this slide is showing, is under different scenarios where you make different allowance for government policy implementations, how much of a reduction in the emissions would we expect to see? So we found, we would fully expect that when we redo this year, things may have moved a bit, and obviously the scenario where it's allowing for expected implementation is highly uncertain, because it really depends who the next government is and what they actually are going to do. But again, it just helps inform decision makers within our organisation around how big a gap could we have, and what are our options for closing that gap. So you can see this is saying, look, if under scenario B, if we allow for kind of announced policy implementation, what would the gap be? And there'd be a 9% gap against our 50% reduction target by 2030. So how do we close that 9% gap? And the other thing to say, we haven't looked at 2050 yet, because if 2030 is difficult to have any certainty around, 2050 is even harder. But that's obviously something that will need to come with time. So how do we close the 9% gap? And I'll come to that in a second. But in terms of this slide, it gives a really good perspective on how much of our book do we need to, where should we focus our attention? So if we're trying to, as a lender, trying to take actions to make our portfolio more efficient from a carbon emissions perspective, how much of our book can we focus on? Clearly, if most of the book was A to C, there'd be less to do. But as you can see, 71% of properties were below C, EPC of C, and toward, you could say, well, it really depends on how spread the book is from, below C. Is most of the book in EPC D and there's very little to do, or is there, quite a large proportion of the mortgage book that has, much bigger changes needed to make them more energy efficient? So 18% would need over 5% of the property value to get there. I'm not sure if asset value is property value or loan value, but Joe, you can probably confirm that.
It's property value.
Property value, right? Yeah. And in our transition report, we disclose what we think the average cost would be to get properties to C. I think it was 3.1% in our transition report, but or actually in our reporting accounts, but you can look at that yourself. So that gives a bit of a flavour of how far we have to go to make our mortgage book more energy efficient, from a point of view of reducing our carbon footprint as a lender. So there are lots of different ways to do that, and I really like this way of thinking about it, because from left to right, it's different levels of involvement in helping your customers. Energy efficiency and education. A lot of our customers don't really know what the options are or how impactful they are, and there's a lot of misinformation out there. So you could say that actually just by providing free information to customers, that will enable them to take some fairly simple steps that could get properties that are EPC D up to EPC C, and even if they're lower energy rated properties, even small changes are helpful. So it's hard to argue against providing more information and access to the right information, and certain customers will appreciate the information in different ways, so that it enables them to make decisions that are best for them. And then you get into retrofitting. So retrofit is the big one, and the most complicated one. And again, even when you talk about retrofit, you can be talking about some fairly straightforward changes up to fairly large, structural changes to a property. So how do we inform customers about, here are your options for retrofit, here are the typical costs, what are the potential benefits, and how can we help you? Because a lot of customers won't necessarily want to take that on. They'll see it as a big project and something that they don't necessarily understand how they can do. But it can be as simple as replacing a gas boiler with a heat pump if the property is already fit for purpose in terms of structure and insulation, or it could be installing solar panels, and probably smaller things around minor changes to the fabric of the building, up to quite significant ones. And then in terms of the finance, well, a lot of customers and people with mortgages don't necessarily have the capacity to take on further debt and to be able to service that debt, to pay the interest payments. So this is where lifetime mortgages really come in, and next release mortgages, in that the customers don't have to service the debt. They can borrow money against their property, and they don't necessarily have to pay the interest. And that can mean that some of the benefits they get are immediate. So you can have a customer or a potential customer where they're struggling with the cost of living, that they've got a property that has a high value, but they don't have excess cash to be able to spend this on making changes to their property. So a lifetime mortgage enables that by allowing them to take out equity from their property and spend it on things that will make their home more energy efficient, which would mean it's more comfortable, reduce their energy bills, which will have a real impact on their actual cost of living. And to the extent that those customers want to do something to improve the carbon footprint of their home, it will obviously help them with that. So that's where lifetime mortgages can play an important role. But the key part of that is making sure that customers are fully informed of their options, and then they receive suitable advice all the way along the customer journey. So it's not a straightforward proposition, and it's something that I expect will take a while to do it safely and in the right way. But it's certainly something that we've been thinking about, and so hopefully that's helpful from that perspective.
Excellent. Thank you, Tom. I'm conscious of time, so we're going to hop over to Heather. But just to make one last point before we do, we said at the start of this presentation that we've been trying to use old data or old tools for new purposes. And hopefully what we can take from Tom's data presentation is the benefit you got from being more nuanced, whether it's more nuanced and more sophisticated targets through better data, or a more nuanced approach to supporting customers to retrofit, or assessing which properties are actually struggling to achieve a grade C, or which could actually be supported to improve. You do get a more sophisticated approach through better data. So thank you for that. And Heather, the floor is now yours.
Amazing. Thank you very much. All right, just figuring out this. Aha, there we go. So I covered this before a bit. So Bankers for Net Zero, we are very much about looking at the policy blockers that could prevent lenders from reaching their net zero targets, and remembering that something like the Net Zero Banking Alliance, those are voluntary targets, but actually UK has legislated for us to be net zero by 2050. And so all of these kind of initial moves that have started to come in on a voluntary basis are already making their way through the economy on a more regulated basis. So this is something that is coming down the line, and particularly I think a lot of homeowners don't realize, particularly if you're a mortgage holder, that this is the type of information that's going to need to be part of the normal kind of mortgage journey. So we're working in kind of in few. There's a great deal of work that's kind of going along in this area, but back to the data point, I cannot stress enough how poor the data is for the purposes of financing. So EPCs were never meant to be a measurement tool in the first instance, and they certainly weren't meant to be a financial measurement tool. And so the data that's accessible via an EPC is so blunt as to be, I don't want to say, there's modeling that can happen on it, but the more accurate that we can get with that data, the more original source data, so the kind of points 1 and 2 to the original presentation there, the better, the more that we can unlock finance to really work, and that's going to stimulate investment. Obviously, there's a great deal of work in terms of like the skill sets that are going to be required to do all the work we need. But all in all, with the right kind of interventions, there's an opportunity to create quite a bit of jobs and growth and healthier homes within the UK. Now, there we go. So I want to talk to kind of what we consider probably the three of the biggest game changers in this space. So we've got looking at things differently. So first and foremost, EPCs, they need to go. And I'll go to that to the next step. We need a better measurement tool that is much more dynamic and allows lenders to track how their emissions are reducing in real time over the course of a property's life as work goes on. So to that point, we're very keen on the idea of having digital logbooks. So something very much like the logbook for your car, but for your property, something that stays with your property. It records when work's been done, what work's been done, and also is able to link into some of the more interesting projects like that we're doing around potentially getting, your real life data from your smart meters. So you can actually start to see the impact of the work that you get to do. And critically, we need to disaggregate cost of supply of electricity and of power from fabric of the building interventions. EPCs now wrap that up, and you can have a situation where a heat pump actually takes your property from an EPC to an EPCC to an EPCD. So we need to kind of square those circles. So that's one of the big areas that we're working on. Clearly, within particularly in the kind of social housing market and where you need to do kind of larger scales retrofits, there's a huge role that can be played by development banks and kind of the public finance institutions, particularly around things like governments taking a slice of risk, so providing an element of a guarantee to loans to help de-risk the loan for the lender and free up more capital and thereby reducing the cost. This is not a long-term sustainable model, but it is a good model for getting a market moving. And we certainly, of the retrofitting right now, it's still a bit kind of boutique, and we need to make it feel a bit more IKEA for everyone and be able to really get there. And then last but absolutely not least, property-linked finance. So in the States and in France and Germany as well, they have something called PACE lending. And essentially, this means that if you're getting work done to your property, and I always take the example of, when my husband and I first bought our first flat, I think we had about 32 pence in the bank account by the time that we'd kind of paid all the fees and all the rest of it. And if somebody had come to us and said, "Oh, but if you could just spend £1,000 on doing X, Y, and Z," we would have, it was just a physical impossibility. So what property, and we knew that we weren't going to stay there for a long time. It was the first property. So you don't want to make that kind of bigger investment into something you're not necessarily going to value, particularly if it's like a high cost, over 10 grand or so. So property linked finance, what it does is it looks at a major bit of work on a property and that has maybe a 20-year payback period. And actually the debt then stays with the property and gets recouped via, well, in the States, they use it via property taxes. There would need to be kind of changes here, but you could actually recoup something like that through council tax. So actually what you have then is either a 0% or a very, very low percentage loan that's being paid off over a long period of time, and it's very much user pays. This is, really can take away a lot of that upfront cost. And so really, when we're looking at the huge upfront cost barriers that we have, there are things that can be done with critically getting the right data points so you can track them, and some of the legislative changes that we can bring in. So right now we co-convene the finance working group for the National Retrofit Hub. And so right now, the core focus for us right now is EPC. If we don't get those core data points right, we're always going to be stifling the funding market. So we're very, very clearly focused on let's get the EPC, get those first data points correct. And then that really opens up the opportunity for lenders to innovate because they're working with more accurate data. It means that they can price things more competitively, and also means that they're able to track quite consistently how it kind of move forward and really kind of up the level of detail for engagement with customers. So we were more than happy to kind of talk about this reform, and very clear when speaking with governments that that getting the EPC reform right is going to be critical for making sure that our mortgage market moves forward in a way that can support this agenda. And yes, and absolutely, in terms of I'm going to the quick question that Regina just put in there. Absolutely, I think that it's going to become much more common that these kind of net zero targets are going to start to become contractually become part of mortgage contracts, because ultimately the lenders themselves are contracted to the government to a certain extent for reducing emissions, and that needs to kind of work its way down through the thing. So the big point for us, of course, in the UK with our older housing stock is reforming EPCs and reforming the metrics in the way that we can measure to a way that is much more multifaceted, much less of a blunt object than EPCs, so that it can take account for the older building stocks and embedded carbon and newer builds. So I think we're just about at time there, so I'll probably cross over there. But yes, thank you very much.
Thank you, Heather. And again, not to be too reductionist, but I think one key theme there from Heather's presentation is how better data, more advanced data leads to better lending and more advanced and sophisticated forms of lending as well, and lending products, something which I think the industry itself is crying out for. We've got 1 whole minute left on the official time. I'm happy to stay on for a few minutes, answer a few more questions. Let's start from the top. So we've got a great question here from Mike Lindsay Bailey. 0.3% of homes constructed in the last century are net zero ready. What do you define as net zero? For this stat, we use the number of properties which essentially have some form of electrical heat, or a heat pump, for example. So the sense was, if the national grid was net zero tomorrow, which homes in this property would be net zero? I've got a feeling this stat was pulled together before the increase in the rebate. So maybe that number's higher today, but it's certainly not a particularly large number. What's a better metric that I need to report on if given the issues with EPC? Our own view is that emissions is a really important metric for a number of different reasons. First of all, it's much closer to our decarbonisation goals. You get properties which are highly efficient, but use fossil fuels to power them and are quite large homes. They can still be quite polluting. So emissions is a truer reflection of how we're performing towards net zero. Equally, it's a more accessible and comparable metric as well. There's a question further down, and you're talking about securitization, the role of capital markets. If you're talking to a US investor rather than a UK one, they don't know what an EPC certificate is. If you're talking to an investor that looks across multiple asset classes, you can't compare an EPC rating for a home to, say, an auto manufacturer, but you can with emissions. So we think emissions is a truer metric, a more accurate metric, but also it carries one which supports you in investor conversations as well. So we're happy in some ways that has been reported on a finance emissions basis. I've got a question here. What does it mean to improve the PCAF score? Well, potted history, but PCAF's there to prevent anyone from reporting their emissions or saying we haven't got the right data to report emissions. So it's basically a data quality score. What that means is when you go back to the regulator and when you're reporting back to your investors, your stakeholders, you're saying, here's the finance emissions number that we think we've got to. This is the carbon intensity of our investments. But equally, here's how accurate our data is. So you can be scored on both. So as well as the emission scoring, it's how accurate your methodology is. The benefit of having a better PCAF score, the benefit to answer the next question of being front foot on climate to a lender is manifest, really. So there's lots of data out there which started to draw a link between property value and energy efficiency and environmental impact. A lot of that's driven by the cost of heating an inefficient home. And so lenders which are supporting decarbonisation are potentially supporting properties to hold their value and in certain times ahead. If there is more climate legislation, if landlords suddenly stop wanting to buy a property which is a D, E, or F grade, for example, maybe that will further bolster the valuation of A to Cs. So it's more future focused in that sense. You're also obviously reducing risk as well, because transition risk, again, as much as we may point out some flaws in the EPC methodology, and it's still the language of government. It's the language in which regulation is written. And so having more properties at an A to C level is lower risk, regardless of what comes down the track either next year, 10 years or onwards from now. And then lastly as well, a lot of lenders are either they're awake to their own role in supporting climate change and aware they need to do differently, or at the very least, they want to assure their customers that they are climate friendly and investors such they can qualify for ESG investment, so they can attract the green pound, if you like. So lastly, we do think that being a climate forward lender is a future proof strategy. It's also key to attracting the next generation of customers to your services. We've got a question here from Alison Proctor. Later life owners with unencumbered properties is a sizable chunk of the market and can be securitized for retrofit, leading the way for others to follow. How will you roll this out? What I love about this question, Alison, is you pointed to the critical role that capital markets can play in getting the gears turning and funding the transition. I've got a feeling this is a very difficult question as well, and squarely directed at Tom. So, Tom, any easy answers to this one?
I think they can. I think one of the challenges that we're trying to address is getting this retrofit guidance agreed within the later life market, and then hopefully a standard, so that capital market investors can rely on the processes that we're following within the industry, so that they can recognise the impact that retrofit lending is having. I would like to get to the position where if you explicitly lend to make a home more energy efficient and you can prove the impact it's had on the carbon footprint, can you use that as avoided emissions, for example? And the standards around that haven't really been developed to support it yet, but you would like to think fairly soon in the next few years that would be there, and then you can have confidence as an investor in securitizations that later life retrofit lending is actually delivering what you think it's delivering.
Absolutely. We're just back from Barcelona for the Global ABS conference, and the sense we got there is actually very similar. There's a willingness to do more in this area. There's interest in investment, and certainly if you look at other asset classes, there's improved liquidity, there's a price premium for green assets or ESG assets. And we've even seen increased liquidity for property assets with the right data to support investor conversations, but we haven't seen the same sense in terms of pricing benefit for greener assets. And a lot of that comes down to a lack of data. So more data, more regulation, more sophistication at industry level, I think that could go a long way to unlocking those benefits. We are now at 4 minutes past the hour. We've gone slightly over, but thank you all very much for your time, for joining the webinar. And thank you especially to our presenters, Tom and Heather. We'll hear from all of them again soon, I'm sure.
Thank you.
Thanks all.
Cheers.
Have an excellent afternoon.